All right, in the Canadian mortgage landscape, we've seen a lot of chatter about mortgage interest rates and the potential of interest rates coming down sooner than we thought. The truth of the matter is, although we are seeing the potential signs of mortgage interest rates coming down, which would make everybody very happy, it may not be happening as soon as we might think. And there's a lot of reasons behind that, which we're going to cover in today's video. For the sake of today's video, we're going to talk a little bit about why interest rates may not fall as quick as we might think, even though the signs, traditionally speaking, are pointing to it. And what could this mean for the Canadian real estate landscape? So there's actually 5 reasons that we pointed out as to why interest rates may stay artificially high for a little bit longer than we initially expected. And some of them might surprise you. Wait till the end where we talk specifically about the overall influence on the marketplace that you could anticipate as we look at going forward. Hey, by the way, don't go any further until you hit that like button and subscribe button. I know not everybody likes hearing it, but if you're getting any value out of this information, please go ahead and do that. And whether you agree or you disagree with anything I have to say today, please leave a comment below. It'd be really helpful to understand from a feedback perspective, and just generally speaking, I'd love to have a conversation with you so we know if we're hitting the nail on the head with this type of content here today. So let's get into it, shall we? First and foremost, there are 5 key factors and reasons why mortgage rates may not go down as quick as the overall market says it should. And if you're wondering why we're having this conversation, just a few weeks ago, we saw the Canadian bond yields start to dip. Now, what's a dip? A dip basically means on a trend chart or a trend map, the actual valuation of Canadian bond yields decreased or declined. And it actually declined quite a bit, all things considered. After hitting the extreme highs in September of 2023 at over 4.25%, the bond yields have dipped down by over 20 to 30 points in the matter of a week to 2 weeks, which is a very dramatic move to rates that we haven't seen since earlier in 2023. Now, there's a lot of economists and a lot of prognosticators that are out there suggesting that it looks like we may have turned the tide, and it looks like that could mean no more increases to fixed interest rates. But are they right or wrong? I don't know, but we'll talk a little bit about why one side or the other could be right. Let's get into it. So we talked about dipping bond yields, but before we go any further, let's talk a little bit about bond yields themselves. So firstly, government bond yields are typically considered a pretty safe place to put your money. And when we're seeing these bond yields dip, it means that investors are typically looking for even safer places to put their money, which can actually devalue the value of a bond yield. And this is one of the reasons that we typically see fixed interest rates go down, is because quite often they're tied closely to the bond yield market, but that's not always the case. Okay, so reason number 1. We talk about swap volatility. Now, this is a little bit complex, so we're gonna try to break this down as straightforward as possible. Basically, interest rate swaps are tools that banks use to manage the risk of changing interest rates. Put it more simply, they're like an insurance against rate fluctuations. When the market for interest rates becomes volatile, banks and lenders tend to become more cautious. They avoid slashing interest rates because there's a concern of the potential of a bounce back, therefore losing money. And for that reason, we typically will see them hold tight during these times. Reason number 2, banks and lenders, their own actual balance sheet. Believe it or not, banks and lenders are businesses. They want to make money. And when it comes to mortgage interest rates, well, there's 2 factors at play this time of year. Number 1 is when they see bond yields start to dip, well, their profitability actually increases. So even if the market's going down, they might choose to keep interest rates higher for longer because it impacts their bottom line and essentially allows them to profit for a greater amount. And that's the truth of the matter is, so if one isn't, the other one may not choose to actually lower interest rates to keep their profitability up. The other factor is that typically during the winter months, so November, December, January, and February, banks aren't as aggressive on interest rates for that very same reason. They know that it's a slower time of year. They'll generally speaking keep their interest rates higher during these interest rate times. Reason number 3, they call it credit spreads, which is essentially the difference between what a bank may charge on an actual loan when it comes to the mortgage pricing relative to what they charge to consumers. Basically, what this means is the actual profitability or the cost of the actual money being passed over to a consumer. Essentially, what the banks are looking for is a wider spread, which allows them to have a greater amount of profit. As you can imagine, when there's a greater amount of uncertainty or turbulence in the marketplace or any unknown, the banks are unlikely to be able to reduce those spreads, therefore keeping their profitability high and their certainty high that they're going to make more money for longer. The reason number 4, another reason why you might see banks keep interest rates higher for longer, is regulatory changes. So in Canada, there's a governing body called OSFI, MSFI, and they have what are called capital requirements for banks or lenders. This is the amount of money that banks need to keep available. Basically, in case of breaking glass moments, they need to have a certain amount of capital or cash available. And this is what allows them to cover for defaults, people not paying off their loans essentially, or foreclosures. Because as you can imagine, if people are doing that, it's going to start to cost these lenders and banks a lot of money. While during recessionary times or times that are looking like more uncertain, typically speaking, banks have to increase their capital requirements by a lot of money. And so for that reason, they also want to increase their profitability for putting that money aside for those capital requirements. Reason number 5, deposit rates. Well, if you've been looking at your bank recently, you might have noticed one thing. And that one thing is that the actual interest rates that you could get paid on things like a deposit, a GIC for that matter, those rates have gone up. In fact, we're seeing banks and lenders giving 4.5, 5.5, heck, even 6% plus. But it's kind of like a seesaw. When deposit rates go up, they have to balance their books. And so for many reasons, they want to reduce the amount of money that they're putting out in loans and increase the price associated with that because they're paying out more in the form of deposits. And so when we see these GIC rates high, we will actually have to see the GIC rates and or any other deposit rates start to go back down before you'll notice a notable impact in mortgage interest rates. So if these yields continue on the downward trend, you can expect that you'll also start to see deposit rates go down. Is the end of the GIC at 5% plus close? I'm not sure, but I think it could be for that reason alone. Another bonus factor is that central banks and their opinion on the marketplace. We've heard recently that the US Fed came out and said they may not be done rising interest rates, whereas the Canadian BOC has suggested, at least most recently, that they believe they could be close to the top or very well done with increasing interest rates. But again, even they have said that they're not necessarily completely finished. The banks pay very close attention to what happens with the BOC and with the Fed. And so best believe when we hear from the central governing and banking bodies that if they believe that interest rates could still go up and they're not done going up, the banks are going to follow suit and listen to everything that they have to say. Well, we can't forget this nugget. At the end of the day, inflation plays a role in all of this, and the central bank has committed to a policy rate initially of 2%, but probably more closely tied to 3%. And those policy rates will also dictate where interest rates end up going. Because at the end of the day, if interest rates drop too fast, people start borrowing more money, and when they borrow more money, they spend more money, and then that vicious cycle continues to turn itself all around and around and around, which is not a good place to be because we'll be back at square one with interest rates rising at a dramatic level and a place that's not really good for the overall economy. So what exactly could this mean for the real estate market in Canada as we move forward? As we know, in Canada, we have a very unique landscape where we have very different markets in different parts of the country, like Vancouver, Calgary, Edmonton, and all the other markets throughout the country have very unique and dynamic markets. We've seen Toronto fall off a cliff in the last few months, whereas Vancouver has come down, but it seems to have stalled. We're still seeing things stay strong in Alberta while they typically have a quiet winter and other areas of the country. What exactly does all this mean? There's one thing to keep in mind is that in real estate in Canada, it's very dynamic. We deal with the potential of government intervention and government changes like we've seen in British Columbia in the last couple of months with so many different changes and rules in place. We know for a fact that the federal government has a very key focus on housing and what's going on, and we suspect that in 2024 and 2025 that continues to ramp up as we get closer and closer to election and people are paying more attention to what's happening in the housing sector. And oh, don't forget, we have likely over 500,000 people coming to our country in the next year and couple of years, which basically means we are going to continue to need more and more and more supply. So we still have an issue with supply, and demand is continuing to be through the roof. So you combine all that with a very sensitive marketplace that's going into some form of financial recession. This could mean that although we don't expect the actual market to take off like crazy in 2024, I do believe that there's a very good chance that the government is trying to weigh that fine line between dropping rates too quickly and seeing the market take off and keeping them even artificially high to make sure that they just slowly start to ramp up over the course of 2024. Chances are very good that we could be near or at the bottom of real estate prices between November of 2023 and January of 2024 before we start to see things pick back up. And I could be wrong. But the reality of the marketplace is that it's extremely frothy, it's still very hot, and there's still a lot of people that are waiting on the sidelines. The questions that most people are asking is, are we going to see a 2024 that takes off the same way as we saw in 2023 with people getting back in the marketplace? Now, I certainly believe that the chances are very good that we don't see things take off the same way we did in 2023 because there's less money going around and there is a little bit more of a credit crunch. But I do believe that the market is still strong enough and there still is high enough demand in many different parts of the country to be able to support real estate prices at least staying where they are, if not increasing over the course of 2024 and beyond. It'll be curious to see. Please make sure to let me know what your comments about that are below, because I would love to know as well. So at the end of the day, while sinking yields may immediately trigger people to think that fixed interest rates are coming down, there's a little bit more at play. And ultimately, we'll have to take a wait and see approach. But if you're predicting that interest rates come down and that will impact the marketplace, I think you're probably right. It's just not right away.